right. Hey, everyone. Happy, what is it today? Wednesday. So, Brennan, I think a lot of people already know you. For those that don't know you, I want to take a moment and introduce you to the group. Um, Brennan, tell us a little bit about yourself.
Yeah, absolutely, Sonny. Good to see you again. My name is Brandon Moncrief. I'm the principal and CEO of McLaren and Associates. I live in Austin, Texas. That's where our company is based. And I've spent the last 22 years in the dental industry, about half that as a banker, lending money to dentists all across the country, and the other half as a sell-side advisor, practice broker, both in the doctor-to-doctor space and in the DSO space. So been involved in about, probably 1,500 practice transitions now. Over the past few years, really focused on DSO private equity transactions. We've done well over 100 of those transactions, and sell side only. We represent dentists, we represent sellers.
Yeah, and we're going to talk about the hottest topic of the year, DSOs. I posted something a few days ago about DSOs and talking about the myths and the differences in opinions that people have, and sometimes they're good. I mean, there are a lot of dentists from the group that have actually transitioned their practices to a DSO, and they're very happy with it. There are also people that aren't very happy with the decision that they made, and I think they're kind of having second thoughts and regretting what they signed on the dotted line. And then there are people that are completely against it. And to be honest with you, I think I've been on the fence for the longest time, and we had this discussion last time when we did this Facebook Live. If you had asked me 2-3 years ago, I can sit down and do a calculation on how it makes sense to keep your practice. Then fast forward with the pandemic and with everything that's been going on with short staffing and anything you can imagine, dentistry takes a mental toll on your health, and trying to figure out how to navigate that, trying to figure out what's the best option for you as a practice owner is hard. I think a lot of us have been dealing with staffing issues. A lot of us have been dealing with patients that are just not the way they used to be 2 years ago, 3 years ago. So there's so many moving parts when it comes to that. But I think one of the biggest things is really to start talking about the myths that are surrounding DSOs. So just tell me some of the things that you hear from dentists, why they don't want to sell their practice, and from dentists that have done so, and what were their reasonings behind it.
Yeah, like you said, and as you see when the topic comes up in DIG, it's a very polarizing subject, and people tend to have a strong opinion one way or the other. There's practice owners that have gone the DSO route, had a really good experience. Some have had a really bad experience. Some have no perspective, but a very, very strong opinion on the subject. I think a lot of the myths are, DSOs are going to come in and tell you how to run your business, and they're going to change a lot about your practice. I think for some DSOs that's true, and then for others they're very hands off. They really change nothing. They're just in the background helping from an administrative perspective. I think a lot of that comes down to your why, right? That's the first thing we start with. Like, why are you considering a DSO affiliation? And does it really make sense? FOMO is not a good reason. If you had a bad day or happen to lose your office manager and it's been hell replacing her, that's not necessarily, a strong enough reason to consider the DSO route. And the younger you are, the more runway you have, I think the harder it is to make sense of it purely from an economic perspective. There's myths out there about the equity component. If you're going to retain or roll equity, does that equity have value? Is it actually going to be liquidated? Is the DSO going to accomplish their financial goals? Because a lot of what they pitch is the generational wealth that equity, could generate. The reality is that some DSOs are going to be successful in accomplishing their financial goals, and some aren't. We've had clients that have partnered with DSOs and hit recapitalization events at really, really good multiples. And those are fun days when I'm getting text messages and, giving high fives to clients that have reached that point. There will be a day, I'm sure, at some point in the future, hopefully not with our clients, but when some DSOs don't recap or recap at a much lower multiple, and the wealth creation opportunity was not what it was explained to be. So it'll be very interesting to see how that plays out over the next 5 to 10 years, because this is a relatively new phenomenon in the dental industry. It hasn't been tested long term, but so far so good as far as our clients go. But that's because we're super intentional and careful about what DSOs we allow to sit at the table when we take an opportunity to market. What other myths have you heard, Sonny?
Well, so I think the biggest thing that I've heard is that this is all paper money. This is all, you're going to be told this is what the value of your practice is, but when the time comes to really cash out, that's when you get to find out that the money's not there, or there are stipulations in place that, well, you didn't produce this much dentistry as promised, or things didn't go well with your practice, or we didn't meet our profitability goals with your practice, so therefore you're not going to get paid what was discussed. So there's and I think this is this really stems from the fact that over the last 2 or 3 years, I've had people message me and ask me, hey, do you know anyone that represents a lawyer, basically attorney, that represents dentists with a failed DSO situation? And when I ask them what happened, a lot of times it's just basically the same thing. We were told this is what the value of the practice was. This is how much we got up front. This is how much we were going to get over the years. And the part that's supposed to happen in year 2, 3, 4, 5 didn't happen. Or things are starting to get to the point where they feel like they're maybe even let go. There's one dentist that said that he was let go. So theoretically, I'm not sure where it stands right now, but that his contract was basically voided because he was let go. Like, I guess like he wasn't the right fit. So these are all things that people are somewhat disappointed about. And I think the one common thing that I found with most of them was, when the time came to value their practice, they relied on the consultant that the DSO had hired. They relied on the consultant that the DSO was working with. And that made me believe, especially after talking to you for the last, 12, 15 months now, to realize that, and I didn't even think about this, that there is representation on the seller side as the dentist, because you're just thinking, okay, some consultant out there says, hey, your practice is worth this much, and we have a DSO that's looking. Well, then you have no idea that consultant might be actually working for the DSO. And then when you do sign the final paperwork, that's when you realize that representation is to the buyer, to the DSO, and not to you. That's been the common thread with all of these failed DSOs, that they just didn't do their due diligence. They just didn't look deep enough to figure out what are the what ifs behind it, that could basically put their valuation at risk, that could put their final cash out at risk, basically. And some are like, hey, I'm so disappointed that I just want my practice back. But now you can't get that practice back because it's not yours anymore.
Right. So a lot to unpack there. You mentioned buy-side representatives. There are people out there that pretend that they're protecting your interest, but at the end of the day, they're getting paid by the DSO to bring you to the DSO. In that scenario, they represent one party and one party only, and that's the DSO. You've got to have your own sell-side advisor that has a fiduciary responsibility solely to you, that's got the experience and the relationships to represent you, and honestly to negotiate the hell out of the deal. I mean, if you don't create optionality, if you don't create competition for your practice, if you don't have somebody like us on your side of the table, you're going to leave money and optionality on the table. A big part of these transactions is the strings that are attached, whether that be an equity component, an earnout, a holdback, and you want to remove as many of those strings as possible, or at least make them black and white, very succinct in the way they're written, so that there's no disagreement when the next payment is due to you. You feel like you hit the threshold necessary to receive that payment, and the DSO has another opinion. We don't really see that happen. We try to mitigate as many of those strings that are attached to these deals as possible by creating that highly competitive environment. From an equity perspective, like I said, we haven't had any clients lose their equity. We have had clients liquidate their equity at handsome returns. So haven't seen that problem. I have had one client be fired by a DSO, and I would say that it wasn't the DSO's fault in that situation. He was very difficult to get along with. He could not keep staff. He didn't treat people well. And as a result, the practice was really suffering, under his leadership post-sale. And they didn't have a choice but to let him go. But there needs to be triggers in your agreement. A DSO has to let you go for cause, right? And then what happens with the equity component if you're holding equity? You've got to line all of that out on the front end. The reality is most DSOs are going to want you there as long as you're willing to stay on. Your job security is not at risk, so long as you sell to the right DSO. And I'll say also, a lot of that comes along with, again, identifying that why, right? What were you trying to accomplish in the first place when you decided to pursue a DSO affiliation? And your why oftentimes dictates who you sell to, what type of deal structure you accept. And if you don't clearly define that why, and you sell to the wrong DSO, you're going to be miserable post-closing. You just gave up all the equity in your practice and didn't accomplish your ultimate goal. Your attitude is probably going to suck, right? And as a result, you and the DSO aren't going to get along. The writing's on the wall that you're either going to leave prematurely and leave money, leave equity on the table, or the practice is going to suffer because your bad attitude is contagious and it impacts staff morale and performance, and the DSO is forced to let you go. So you got to go into this identifying your why and making sure that you create optionality, meet with a lot of different DSOs, and only sell to somebody that's in a position to help you accomplish your goals, or else, regardless of how much money they give you on the front end, you're probably not going to be happy post-close.
Right. And I think that's probably the number one question people ask is, why should I sell? Obviously there are many different reasons, but a lot of times it's okay, I don't want to manage my practice anymore. So then the question becomes, what DSOs are out there that are actually going to take that management equation from you and actually start doing some of the work? Because that's the other thing that comes up is, well, if I sell my practice, but I still have to worry about the staffing, if I still have to worry about hiring and firing, if I still have to worry about the overhead expenses, like what kind of support am I getting from a DSO to justify that sale, to justify giving up some of my profits to a DSO? I think that's a big question that comes up a lot is, if you sell, I mean, there's no doubt that you're giving up some profitability. Am I gaining back my time? Am I buying back some of my time? So that means, if I'm done at 5, I'm going to come home and not worry about the practice at all. But I still want to be able to share some of the profits from the practice. So what kind of scenarios do you normally see out there?
In the situation where you're selling because you want to alleviate the management burden, it's not solely an economic decision. And again, this is a very personal decision for everybody. But a lot of dentists, that's what they're trying to accomplish. They're trying to get a better work-life balance. Then you need to be very, very pragmatic in your approach to who you sell to. You need to do your diligence. What type of infrastructure do they have? How robust is it? If you've met one DSO, you've met one DSO. Some DSOs have really robust infrastructure, going to be very involved in the day-to-day of your practice. Some DSOs, they kind of refer to themselves as IDSOs, invisible DSOs. They're going to be very, very hands-off. Now, that's attractive to some sellers, but for others that their why was, I want help from a management perspective, that's not going to work. You're not going to be happy post-close. There's no reason to give up equity and not get the support that you want in return. So you got to make sure you do your diligence, partner with the DSO that's the right fit to accomplish your goal. But look, regardless if they've got robust infrastructure or not, regardless if they're going to be involved in your practice on the day-to-day, the reality is that there is no way to 100% lift that burden, regardless of how strong the DSO is from an operational perspective. You're going to still worry about certain aspects of your business. There's still going to be fires that are right in front of you that you've got to put out as an associate or a practice owner. So to think that you're going to sell your practice and just shift solely into associate mentality, clock in at 9, clock out at 5, and not have anything to worry about, I think that's a falsehood. And if that's what you're looking for, you've got to find some other solution, because I don't know a DSO in the country that can provide that.
Right. Yeah. Yeah. Well, let's talk about what are some of the main reasons you're finding out that doctors are choosing to sell their practice to DSOs.
Yeah, I mean, it's a mixed bag, right? It's a very personal decision. Everybody's in a different place in their life. They have different stressors, both in their practice and outside their practice. So for some people, it's an exit strategy, right? Older docs within 5 years of retirement, they're sick of running the business on the day-to-day. They want to go ahead and lock in their exit strategy, and they can sell their practice to a DSO for a significant premium compared to what they can sell it to a private buyer for. So a lot of doctors are using it as an exit strategy. For some younger doctors, they're using the DSO route for several different reasons. One is what we've already talked about, right? Work-life balance. I think a lot of really successful practice owners have become a victim of their own success. Maybe when they started the business or purchased the practice, they weren't married or didn't have a family. And now they've built, this mega practice that's running them rather than them running it. They're stressed out all the time. They've missed a lot of their kids' youth, and they're looking to reprioritize and take some chips off the table at a favorable valuation, get some support from an operational standpoint, and have a little bit better balance. I'd say that's a big reason that a lot of really young entrepreneurs are looking to go the DSO route. And normally our younger sellers gravitate more towards the joint venture structure as opposed to just selling the practice outright. That way they get to retain some equity in their office. They get to share in the post-closing cash flow of the business, and they don't take such a huge hit from a personal income perspective right off the bat. For some young entrepreneur little doctors, they built a hell of a business. It's got a lot of value currently to private equity. They're like, hey, I'll take the chips off the table. I'll fulfill my post-closing employment agreement, and then I'll go do it again. I might do it 3, 4, 5 times throughout my career. So the kind of build it up and potentially flip it and go do it again. We've seen that happen with some of our younger clients. I will say that younger people are also more transient than they ever been. They tend to move around more. So people have moved to a city, like I'm in Austin. It's a very transient place. A lot of people have moved here from all over the country, all over the world over the past 10 years. And we'll see a young entrepreneurial dentist that's not from Texas move here, possibly, with a wife or spouse, start a practice, buy a practice, ramp it up, and then something happens that causes them to maybe go back where they're originally from to take care of their parents or whatever it may be. So people move around a lot more. So if you have plans in the next 5 years to relocate or switch careers or do something like that, the DSO option offers you the ability to liquidate the business at a really nice valuation and then free up your future. So because people's life plans change more frequently than maybe they did for the dentists that got out of school in the 70s and 80s, there's just more churn, right? There's more practices turning over than ever before. So we have a lot of clients that say, hey, I grew up in Utah and I moved to Texas, bought a practice. I've completely crushed it. My wife misses home, or my husband, misses home. We're going to move back to Utah in 5 years. That's the game plan. All right. We've got a practice that's worth, $2 million in the private buyer space, but $7 million in the DSO space. Maybe it makes sense to go ahead, affiliate with a DSO, take most of those chips off the table, keep some equity, liquidate it at recap, and then sail off into the sunset. You can move to Utah and, live the rest of your life there. So a lot of reasons, and it's very, very personal. And I see when we post about DSOs on Dig, a lot of people are like, why the hell would you ever sell your practice to a DSO? That makes absolutely no sense. You're giving up all your equity. You're just going to become an employee for the rest of your career. There's a lot of situational things that come up for a lot of people that cause this to be a legitimate option. It's not for everybody. If you're happy owning and managing your business and you plan to be in that practice for the next 20 or 30 years, I have no idea why the hell you would sell it to a DSO. I get it. That makes sense. But if you've got some other motivation, then it is a legitimate option.
Yeah, that makes a lot of sense. I've got some questions actually coming up from people. I think one of the biggest things that we've all discovered over the last 2 or 3 years is staffing issues. Do you find that DSOs are better equipped to find staff, find dentists? Because the problems are pretty much widespread for the most part, but are they leveraged enough to be able to find staff, or is that pretty much not even a question at this point, that it's the problems are across the board?
Well, I'd say staffing is probably the number one stressor, right? That practice owners deal with, especially if you have larger practice, larger staff, right? More money, more problems. So I will say that from a doctor talent perspective, a recruiting perspective, a benefits perspective, DSOs are typically able to recruit better than a private practice. They have more resources, they have deeper pockets, they can do more robust guarantees and offer big company benefits. From a staffing perspective, they also have those advantages, but to think that you're going to affiliate with a DSO and they're going to solve all your staffing issues, you can't change people, right? You can't change the labor market. It's a freaking mess right now.
Yeah.
And I will say that they have more resources. You at least have a partner helping drive that ship, but it's still problematic. It's just as problematic for DSOs as it is private practice owners.
Are you also noticing specialists affiliating with DSOs?
I would say half our DSO clients are specialists.
Oh, wow.
In particular, OMS and ortho are the two, hottest verticals within the dental space at the moment.
Why is that?
They're trading for huge premiums, I think, because they're very profitable businesses, and private equity just seems to love that vertical for one reason or the other. I would argue that especially OMS, from a provider standpoint, it has more key man risk than any other specialty or certainly general dentistry. But because of the profitability, because there's less insurance involvement, private equity DSOs love ortho and OMS in particular. But we're seeing the consolidation happen across the industry. It's happening in every specialty. There's now implant focus groups, perio focus groups, endo focus groups, and then obviously a massive amount of general focus groups. And now we see the general focus groups starting to go multi-specialty, and where they have density of general practices begin to buy or partner with specialists in those markets.
Yeah. Well, let's talk about the premium. So let's say if you've got a GP practice that's doing, I don't know, 1.5, 2 million, you go sell to a private buyer. I don't know, you get 80, 85%, maybe, depending on the profitability of the practice, maybe more, 90%.
Right.
You go sell it to a DSO. What kind of numbers can you expect? And then how does that differ from a specialty like ortho or oral surgery, where they might be doing, let's say, 2.5 million? And what kind of premiums would they expect as opposed to a private buyer?
Yeah, so the premium that you're going to receive for your practice in the DSO space ratchets, it increases exponentially as the practice increases in size. So in other words, if you're $1.5 million practice, the top line revenue, general practice, doctor to doctor, you might trade for, 1.2 to 1.3 million. In the DSO
Right.
space, you might trade for anywhere from 1.7 to 2.5 million. And it just depends on how your practice is financially engineered, right? Because you have two practices that both have top line revenue of 1.5 million. The EBITDA of one is 500,000. The EBITDA of the other is 250,000. There's going to be a massive delta in valuation. It's more
Right.
so dependent on EBITDA than it is on top line revenue. DSOs really don't care about top line revenue. At the end of the day, they care about absentee owner profit, EBITDA. That's what drives value.
Right.
So when you start talking about practices with top line revenue of $4 million, $5 million, one, those practices are difficult to sell in the private buyer space. A single doctor is likely not going to buy a practice of that size and caliber. So they're actually going to trade typically for a lower percentage of revenue than a smaller practice in the
Mm-hmm.
doctor to doctor space. And you may have to find multiple buyers, which is complicated, difficult to do. As
Right.
opposed to the DSO space, that practice is going to could easily trade for 2 to 3 times revenue. So comparatively speaking, it could trade for 4 to 5 times what it would trade for to a private buyer. Does that make sense?
Yeah. Yeah. So at the end of the day, when these, and I'm just going to shift gears for a second, because at the end of the day, the PE, they're looking at the cap rate, they're looking at the interest rates. In today's rising interest environment, how does it make sense for them to continue? Let's say if their profitability was going to be, I don't even know what, maybe 15%, 20% on a good day. Um, After all the
Higher.
things are paid higher.
Most DSOs, their EBITDA margin goal is between 20 and 25%. And there are DSOs that are running EBITDA margins as
Wow.
high as 27 and 28%.
And that's
Reason
after
being,
paying the doctor. Wow.
yeah. I mean, we see private practices that are operating at, 20 to 30% EBITDA margins. So you
Right.
can imagine if a private practice can pull that off, a DSO that can leverage payers to get better reimbursement rates and then leverage vendors to get lower cost. It's possible. Now, that's a blended average, right? They're going to have some practices that are not optimized, that are not performing well, but then they've got some overachievers that are performing remarkably well.
So there a huge difference in reimbursement rates from DSOs to a solo practitioner?
There can be. Yep, absolutely. Especially a large DSO that has leverage. And that happens, geographically as well. So some DSOs have, more density in a specific geography and therefore have more leverage against the insurance companies in that particular geography. But they know how to work those angles.
Yeah.
I mean, many of them have a department that's dedicated to, credentialing and insurance negotiation.
Wow. So at what interest rate do you think we'll have to get to for PE to basically say, well, look, we got to put a pause on these transactions. Things aren't making sense. We're not able to make money for our investors. And I mean, are we talking about 10%, 12% interest rate? I mean, what kind of interest rates do you think would have to get to for that to happen?
I don't think we're going to see rates climb to a point where it has a substantial impact on private equity and their desire to continue to invest in dental practices.
Mm-hmm.
The returns are so robust for private equity investors in this space. I mean, you have private equity firms that are generating IRR of 50 to 90% on a lot of these investments. So, a 3 to 5% change in interest rate, does it eat into those returns? Sure, it does,
Yeah.
but it's still an incredible return. So what we're more concerned about is availability of capital. We're more concerned about when banks enter a recessionary environment, they tend to get more conservative and they tend to look harder at the operational fortitude of these businesses. So you're going to have some DSOs that are over levered, some DSOs that maybe can't reach a recap in the timeline that they wanted to, or the EBITDA multiples aren't robust enough for them to trade in that environment. Well, do they have the infrastructure? Do they
Right.
have the deal structure to continue to operate the business longer than maybe they had intended to? You know, they're all on a 3 to 5 year recap cycle. So if you have to operate the business past that runway, have you structured your deals in a manner that the doctors are still motivated? Have you built the infrastructure to actually operate the business, not just build it and flip it? How leveraged are you? Were you overpaying for practices? Were you over levering them?
Mm-hmm.
We're more worried about DSOs hurting from an operational perspective, which impacts their EBITDA margins and impacts their debt covenants. And when they start to trip debt covenants, in other words, the bank says you have to operate at a certain EBITDA margin, a certain, leverage margin compared to EBITDA. When you get outside of those covenants, you're under a tremendous amount of scrutiny from banks. And the bank may say, hey, we're going to hit pause for 3 months. You're not going to buy any practices until you get back within your covenants. If and when that happens, you lose valuable time in your recap cycle,
Mm-hmm.
and it delays your recap cycle essentially, right? Because
Right.
you're not growing, you're operating. So that's what we're most concerned about, is availability of capital. Are banks going to continue to fund the growth of DSOs? And we've seen DSOs more recently, just in the past, I'd say couple of months, get more conservative in the type of practices that they're chasing. I mean, up until 6 months ago, you could get 7, 10 offers on almost anything you take to market. Now, those practices that had 7 to 10 offers may only garner 3 to 5 offers. So you're seeing some pullback in the marketplace from that perspective. I will say that from a valuation perspective, when the DSOs bid, valuations are as high as they've ever been. So we have
Okay.
not seen valuations cool off at all. And that makes sense based on what I just said. If the IRR is there, if the interest rates really don't impact returns to that degree, but banks as well as institutional investors at recap are scrutinizing the quality of the assets in the portfolio, it makes sense that DSOs aren't really worried about valuation. They're worried about quality. So
Right.
they want to buy quality businesses that have a leader that's going to stay on, that have healthy EBITDA margins to begin with, where they don't have to come in and, reinvent the wheel to make the practice successful. So we're seeing DSOs tighten up from that perspective. And look, that's probably good for the industry long term. You don't want DSOs to hold a bunch of bad assets, because
Mm-hmm.
that's going to lead to a lack of confidence from institutional investors, larger private equity firms that are going to be the buyers when these DSOs go to recap.
Right. And for those of us that don't know what a recap event is, will you talk about that for a second?
Sure.
And typically what happens at that recap event, is the dentist getting some cash out at that point, or are they just, I guess, like building up the value of the practice, but still in equity at that point?
That's a great question. So a recapitalization event essentially means that the investor, the private equity firm, family office, whoever it is that currently backs the DSO from a financial perspective, sells the company to the next investor. And at the point of sale, for the most part, everything really remains the same. The management team is required to stay in place. The infrastructure stays in place. The brand stays in place. It's really kind of a behind the veil changing of the guard, just from a financial investor perspective. But at recap, the equity holders, and that's going to be the private equity firm, family office that owns the DSO, the management of the DSO, and then the doctors within the DSO that are holding equity, have the opportunity to liquidate all or a portion of their equity at
Mm-hmm.
recap. And it depends on what type of equity you're holding. Will depend on how much of that equity typically you can liquidate. So if you're in a joint venture structure, you own equity at the practice level, you're likely going to be limited to liquidating up to 50% of your joint venture equity. Because it's a joint venture model, that's the premise of the whole DSO and how they structure deals. The next investor is not going to want all the dentists to sell all their equity. It essentially makes the investment far riskier than it was when you had dentist partners in each individual office. In a holding company model where you hold the equity in stock in the parent company, you actually own stock in the DSO, not your individual practice, you typically have the opportunity to liquidate that equity in full at recap. But those triggers, what happens at recap, you want to try to negotiate as much of that as you can in your initial deal so that you know with predictability, you have a legal contract that says, I'm allowed to do this at recap. I get the parent company multiple at recap. I can sell up to this percent of equity at recap. The more you can line out in the upfront legal agreements, the more predictability you're going to have in what your financial world outlook looks like, from a recap perspective.
And I assume that's how doctors get in trouble when they overlook some of these things, because they're, obviously trusting the agreement that's been provided to them by the DSO. And obviously it's going to be a one-sided agreement when there has been no negotiation and you're just taking their word for how the deal is structured.
Yeah, and some things are negotiable and some are not, right? But you got to at least ask the question. You got to go into it with eyes wide open so that you didn't read the fine print, you didn't have a good attorney, you didn't have a good sell-side advisor. You get to recap and it's like, oh, well, you entered the recap cycle too late to participate. So therefore, you have to wait till the next recap cycle. So, well, I just waited a year. Now I got to wait another 5 years. You've got to ask the right questions. And
so when you're looking at these DSOs, how open are they to letting you look into their financials? I mean, is it an open book, or
even if it was an open book, you wouldn't be able to make sense of it. So there's not a clean line of sight for really anyone to evaluate how healthy the DSO is from an economic perspective. You can ask a lot of questions and engage those answers and weigh them against the answers that you get from other DSOs that you're interviewing and vetting during the process. It comes down to the pedigree of the private equity firm that's backing the DSO. What's their history from a recap perspective in other industries and the dental industry? Have they built a successful business in the dental industry and sold it? Because then, they kind of know how to build a company that's going to have value to an investor on the back end. Or is this their first, entree into the dental industry? Are they a new private equity firm or a big established private equity firm? Talk to the DSO. Have you had a recap before? How many? If so, when? When's the next one projected to be? What's the projected financial return at recap? And then talk with some doctors within that DSO and get their take on the equity component and how has life been, pre and post affiliation. It's really, really important that if you look to go down this path, you do as much due diligence on the buyers as they do on you. As I just said, you're not going to be able to do as much financial due diligence as they can on your business, but you got to try, right? You've got to at least ask the questions and evaluate the responses.
So from a financial standpoint, some of these DSOs that are popping up that virtually they have no money, but they're basically saying, well, let's form a DSO of all these practices in, let's just say my town, Cincinnati. You become part of this DSO. What's not really a DSO, you just become part of this group. And then once we have 20 some practices in that umbrella, we're going to reach out to a bigger DSO and try to sell at a higher multiple. Like what kind of structure is that some of these guys have been talking about lately?
I'll call it a gimmick. So there are groups out there right now I'm glad you asked this question. It gets me pretty heated,
Well, I'm seeing it more and more.
off my seat. Yeah. So the premise that you can take a bunch of unaffiliated practices, unintegrated practices, and call them a DSO and sell them for a substantial premium compared to what they would sell for on their own is nonsense. It doesn't work. Is it possible to take 2 or 3 practices in the same geography that are very, very similar? The doctors all have the same why, sell them simultaneously to the same DSO for maybe a slight gain, maybe half a turn of EBITDA higher? It's possible. It's been done. But the premise that I'm going to form this co-op, Sonny, you can join my co-op. You're going to pay me $25,000 to join. You're going to pay me $2,000 a month to be part of my group. And the premise is that you and 200 other dentists are going to join the group. And Sonny, your practice is worth 7 times EBITDA on your own. But by joining our co-op, we're going to sell the whole group simultaneously to one buyer for 12 times EBITDA. That's absolute nonsense. The dumb money has left the market.
Yeah.
When you enter the type of economic climate we're entering, banks are being more conservative. Almost all private equity relies on banks for funding.
Yeah.
They're scrutinizing the investments harder than they ever have. Even legit single location practices are being scrutinized. They're going to rip something like that apart. And you're seeing these groups pop up all over the place. I will tell you that these groups are designed to do one thing and one thing only. And that is to line the pockets of the people that formed the group.
Formed it. Yeah.
Right. It's set up in a way that they make money no matter what. If a transaction occurs, great. We hit a grand slam, 2 outs in the bottom of the ninth. Never thought that would happen, but hey, we got it done. But if it doesn't happen, they've bled you dry with fees and promises along the way.
Yeah. And just so I understand, this is obviously not the same thing as a DPO, correct?
It is not. It's
okay,
not.
So what are the differences in a DSO and a DPO?
So that's a great question. I mean, they're essentially the same thing with one caveat. I will say, a DPO is typically a joint venture structure, a doctor partnership organization. A true DPO, in my opinion, is a joint venture structure where the doctor sells a majority ownership interest in the practice, but still retains equity at the practice level. Okay. A DSO, in my opinion, would be categorized as an entity where they buy a majority interest in your practice, but your equity lies at the parent company level, the DSO level.
Gotcha.
Now you will see what I just categorized as a DSO refer to themselves as a DPO and vice versa. But DPO is, in my opinion, it's another name for DSO, and it's a way for buyers to distinguish themselves from maybe the negative connotation that DSO carries.
Makes sense.
It's a marketing tool for some DSOs.
Yeah, because at the end of the day, a lot of the big selling points are when you partner with us, you're able to leverage your practice from the standpoint of better fee schedules and better reimbursements, obviously, and maybe lower credit card processing fees, whatever the case might be, better lab fees and supplies, all that kind of stuff. Is that truly the case where there are significant savings in those arenas to justify some of that decision making?
It's real. I will say it's more impactful the larger and more well run the company is. So yeah, can they move the needle from that perspective? Yes. Now at the same time, they're probably going to charge you a management fee. Right. So that management fee should be offset by the economies of scale that they bring to your practice. That should be the goal, and that should be a question you ask. Hey, especially in a joint venture model, you're always going to see a management fee. Typically, you're going to see a management fee. There's a couple of DSOs out there that don't charge one, but that's because they have no infrastructure, right? So, red flag. If you're looking for support and In a joint venture structure, they don't charge a management fee. That means that they have no corporate overhead, therefore they have no infrastructure. You know, are they going to be
They
able to
provide
support
for,
you the
yeah,
way you want to be supported? But most
right,
DSOs are going to charge a management fee in a joint venture structure. And ideally, you want to ask the question, hey, you're going to charge me 5% of top line revenue. What am I getting in return? Right? What is the infrastructure going to do for me from an administrative standpoint? What burden is it going to lift off the practice? And then what economies of scale are you going to bring me? And I want to make a point also on the size of DSOs, because you talked about equity and does it have value? It's risk reward. Okay. So if you partner with a small DSO, right, they only own 5, 10 offices. They have a goal to get to 150 before they recap, but you're coming in very early
yeah,
in the iteration of that company. There's far more risk there, right? Will they make it? And there's far more time you have to wait until the recap. Therefore, your return on equity should be considerably higher than if you're joining, a very well capitalized, established DSO that's hit 2 or 3 recaps. In that
right.
scenario, you would expect your return on equity to be a little bit muted because the risk is a lot lower. So
Right.
that's something that you need to evaluate as well. How risk averse are you? And that may dictate how large of a DSO you gravitate towards.
So if there was a large, well, and we can talk about this probably all day long about, what's going to happen with the economy in 6 months or 12 months, or if there will be a deep recession, there will be a mild recession, or there will be one at all. I had this question yesterday. How are people's practices doing? In December, I think a lot of us saw a lot of cancellations, a lot of no-shows, and we were kind of starting to kind of worry about. I think it's starting. I think it's kind of getting to that point where maybe things are going to slow down. Maybe we're going to see those people just not schedule their treatment going forward, and then first of the year hits, January hits, 3 weeks in, and people are like guns blazing. My practice is so busy. I don't have any appointments, and I'm seeing the same thing. And it's just like, wow, things are really busy. So what happened in November, December, and all of a sudden things are a little bit busier now, and not just a little bit, actually very busy for some practices. So in your opinion, do you think that we could get away with a mild recession, or do you think we could see something where there's a deep economic reset, deep economic period where there's no growth for years and years to come, and that basically causes some of these DSOs to collapse because they're basically buried in debt? They're not seeing any growth, any profitability coming out of these, or at least they're not growing. At that point, the PE says, well, I want to liquidate. I want to get rid of these businesses that I'm holding. Do you think that that's a possibility?
I mean, sure, it's a possibility, right? I mean, if we go into a deep, long recession, there's going to be carnage all over the place. It's not just going to be in the dental space. I'm
Yeah.
hopeful that we're going to have a mild, relatively short recession. And, dentistry is proven to be recession proof, pandemic proof. It's proven to be a great investment, especially in down times compared to other verticals, other industries. So I'm hopeful that, we've got a long runway of growth and prosperity, both in the private practice space and the DSO space. But look, if you solve why things are slow from one month to the other, you're going to be a really, really rich man, because we can't figure it out, right? I
Right.
mean, Q4 of last year was slow for a lot of practices.
Yeah.
Q4 was weak. And I know that because, we're taking practices to market near the end of the year. We've got trailing 12-month financials through September, and then we go to market, and then we get Q4, right around the time that we receive LOIs, and we're seeing that a lot of practices had a soft Q4, and we've kind of got to rebalance EBITDA and expectations in those situations. It is situational, though. I've seen practices that absolutely crushed it in
Yeah.
Q4 of last year.
Yeah, because if the first 3 weeks of this year are any indication, then most practices are basically going to be approaching their record months, probably.
I hope so. That would be great. But man, it's day to day, as you see in the market, right? I mean, things
Yeah.
are looking good, and then today happens. So
Right, right.
you
Yeah.
never know.
This is a good question, actually. So, how do DSOs find practices for sale? Um, is that because you list your practice with a broker, or what is their process like?
So DSOs have invested a tremendous amount of capital in building marketing machines and business development teams to knock doors, send you direct mail, and try to get your attention as a practice owner and begin a discussion about potentially partnering with them without somebody like me at the table. Their
Hmm.
preference is to do a deal without a sell side advisor at the table, because they know that ultimately, if you don't know the questions to ask, if you don't create a highly competitive environment, if you don't create optionality, if you don't create leverage, you're going to leave money
Hmm.
on the table. They're going to buy the practice for, you know, at least a turn of EBITDA lower than they would if it was in a formal competitive bid process.
Yeah.
So they're all calling on all of you directly all day long because they know that they're going to save money by doing so. So they find practices all different types of ways. One of the biggest ways they find practices is, Sonny, if you sold your practice to a DSO, the day after you close, that DSO is going to come to you and say, hey, Sonny, refer your friends to us and we'll pay you to refer your buddies. And if they sell to us, we'll give you a referral fee.
Right.
So
Because I mean, not, I guess MB2, that's kind of their core model, right? That they kind of live off of referrals.
it's the core model for all DSOs.
Oh, it is.
It is. Yeah, they their best source of deals, what they call proprietary deals that are off market, that are not
Mhm.
being shopped, are the doctors that are already within their network. Those referrals, that's why they can pay
So then those
robust referral
doctors,
fees.
theoretically, those doctors would encourage their friends to do the same. No, don't get somebody like Brennan and just trust me and sell the practice, which could be a horrible thing in a
It
way,
could be.
because
Look, I would
it's
like
just
to.
because it worked out for their practice doesn't mean it's going to work out for their friend's practice. That's kind of the worry part.
I think that's the point, right? They may have had a great experience and they might be sincere in making that referral. They're still probably going to get paid, but they are sincere. They like the DSO. They've had a great experience. The problem, though, is every practice is different and every doctor's why is different. So if your buddy refers you to a DSO, sure, let's put that DSO at the table. Let's give them a shot. But let's not give them the only seat at the table because your practice is different than your buddies. Your why might be different than your buddies. And you want to make sure that you still shop around, right?
True. Um, so what kind of offices are they actually looking for? Generally speaking, I mean, you have tons of offices out there that are doing under a million. Are they even looking at those offices?
It's situational. I mean, if a DSO has density in a particular market, they may lower their threshold and go after some smaller practices. But let's just talk kind of from a global perspective, right?
Mhm.
There's DSOs looking for all types of practices, general and all specialties. Ideally, they like practices, they get excited about practices with EBITDA of 300,000 or more. So in order to generate EBITDA of 300,000 or more, you're typically talking about 1.5 million in revenue or greater. Now, you're still potentially a DSO target if your revenue is in that million to 1.5 million range,
Mhm.
but to have the most bidders at the table, the most amount of demand, to get the DSOs really excited and see the EBITDA multiples come up to a point that the valuation is far greater than the private buyer valuation. Ideally, you're at that $300,000 EBITDA threshold, which equates to about 1.5 million in top line revenue. DSOs prefer to have a larger facility that can accommodate at least two providers. If it's a one doctor practice today, they hope to have multiple providers at some point in time. They love multi provider practices. If there's more than one doc, there's less key man risk. That they like that. And then geography plays a role in it. There's more demand near metro areas than there are in tertiary markets.
Yeah.
And
What part of the country, or what parts of the country are you seeing more of this going on right now?
so New England, the Northeast is crazy right now. Huge amount of
Why
activity.
is that?
Uh, it's just because there's been a lot of DSOs founded in those markets.
Hmm.
Most of the private equity firms are based in those markets. So a lot of the institutional capital that's funding these transactions is coming out of the Northeast.
Hmm.
So really everywhere is extremely competitive right now, with the exception of, I will say, we've had some success in California, but there's not near as many DSOs that acquire practices on the West Coast because they don't love the regulatory environment and they don't love the tax environment. So the West Coast is a little bit more challenging than the rest of the country, but it's hard to ignore. I mean, a quarter of the dentists in the country are on the West Coast. So
True.
you're going to see more and more DSOs go to those markets and figure out how to navigate transactions in those markets. Multiples might be a little bit lower, but you're going to see DSOs go out there eventually. It's already starting. But I will say, like, Texas, the Southeast, the Midwest, New England area, Northeast. I mean, we can create a high level of demand for anything that we take to market. We just took a practice to market not too far from you in
Hmm.
in a geography that I would say is not really desirable. That you wouldn't think there'd be people tripping all over themselves to buy a practice in this particular town. We had
Right.
nine offers. It traded for over $1 million higher than what we valued it at.
Oh,
Uh,
wow.
so you can create a
So
high amount of demand almost anywhere right now.
how do you create competition? So if I hire you, how do you create that competition for the seller?
We spend an insane amount of time building relationships with DSOs, vetting DSOs. We average probably a call a day from a new DSO that is interested in buying practices that fit this particular criteria and this
Hmm.
particular geography. So we manage a database of DSO buyers. We build relationships, we build trust with those buyers. And then when we have a particular practice that we're ready to take to market, we align what the buyers are looking for with the why of the client and try to
Hmm.
put the right people at the table. So there's over 250 DSOs in the country. We
There's
don't
that
put,
many?
there's that many. We don't
Wow.
put every practice we take to market in front of 250 buyers. That would be absolute chaos.
Right.
We like to identify what's the client's why and then look at, okay, what are the top 7 to 10 DSOs in this geography that are interested in a practice with these characteristics that are in the position to accomplish our client's why. And that's who we put at the table.
I got so, and this is probably too specific of a question somebody asked is, what are some of the more reliable DSOs, or what are some DSOs they should avoid? Is, I don't know. I mean, it's probably not good business to talk about names of DSOs, in my opinion, but is that a question somebody can message you and you can talk to them about
We could
that?
have an offline conversation about it. I mean, again, a
Yeah.
lot of it depends on your why, and a lot of
Yeah.
it depends on what type of practice you have, as to how much optionality you're going to have. Sure, are there DSOs that we don't work with, that we won't work with? Yeah.
Yeah.
Are there DSOs that we think very highly of that get a seat at every table? Absolutely. Because we've got trust. We've done 20 transactions and all my clients are happy. That's a DSO that I want to make sure that's at every table. And
Yeah.
I will also say it's cyclical. Some DSOs that are really, really aggressive today might not be aggressive tomorrow on valuation and demand. So we have to constantly keep up with, who's buying, who's being aggressive, and who's a fit for, the client's why.
Are there situations where the DSO wants to sell the practice back to the dentist?
We've never seen that happen. I'm sure it happens from time to time.
Yeah.
I've heard stories, but we've never had that happen.
Yeah. I mean, it would be at that point, I'm assuming the DSO basically realizing that they didn't do their due diligence and maybe they made a mistake and
They made a mistake. The doctor made a mistake. Maybe they weren't ready emotionally or financially, or it wasn't a fit for the why. And everybody's unhappy.
yeah,
And that may be a way to resolve the situation. In that situation, I would think the doctor is buying it back for, less than they sold it for.
right. Makes sense. Yeah. I bet there's 18,000 dentists in this group, right? And I bet on any given day, there's at least 100. They're thinking about selling to a DSO. They're just thinking about, look, how do I take some of the stress off and really try to figure out what's best for my life going forward. Do you have any tips for those people? Because this happens a lot. A lot of people are thinking, they just don't do anything about it because they're just not sure where to even start. Like, what's the number one thing you do to even think about getting started with this process? I mean, are there ways to figure out what the valuation of your practice is going to be, even if you're not serious?
Sure. And that's where we normally start is let's get to know each other. Let's talk about your why. Let's talk about, I mean, that's my first question I always ask. Like, why'd you call me? Why are you considering this? And if I don't think it's legitimate, why, I'm going to say, hey, sleep on this. Like, you don't need to go down this road. You just had a bad day or a bad week or what have you. So you got to get unbiased advice regarding, what is your EBITDA, what is your practice valuation, and help you determine your why, and if it really makes sense from a fit, emotional, economic perspective. A lot of advisors out there, their sole goal is to convince you to sell your practice. And I don't think that's a healthy way to approach business. We're really blessed to be busy because we just do the right thing, try to tell people objectively, where they're at and help them get to where they want to go. And if it's not a fit, don't do it. I mean, it's not worth it, right?
Yeah.
So that's how we approach it. But look, almost anybody with a large practice, revenue over that, 1.5 million mark has thought about it or is thinking about it because you're being inundated with your buddies calling you, direct mail. It's just in your face all the time now. And there's just a massive amount of noise in the marketplace. There's a lot of nonsense out there. There's a lot of snake oil out there. You've got to find somebody that's unbiased, that, really cares about, putting together something that's going to be beneficial for you first, not them first.
Right. This is slightly off topic, but do DSOs make sense for for recent grads, new grads to get hired on?
It's not a bad place to go to work. I mean, especially if you can get a nice guarantee, get your hands beat up, and then, I mean, there's things to be learned, both good and bad, right? Who you don't want to be as a dentist and practice owner, who you do want to be as a dentist and practice owner. I mean, but just because you go to work for a DSO at a school doesn't mean that's where you should stay.
Right.
I mean, any dentist that's got an entrepreneurial spirit, that's, got the chops clinically, should aspire to be a practice owner.
Yeah.
What we're talking about should not be the end of private practice, and I don't think it will be. I think there's patients that value private practice, and I think there's always going to be entrepreneurial dentists that, want to captain their own ship.
Here's a question. Are there any DSOs that are fee for service?
I don't know that there's a single DSO that is solely fee for service, but there are absolutely plenty of DSOs that have high caliber fee for service practices within their portfolio.
And I ask this sincerely because I think one of the biggest fears people have is I'm going to lose my clinical excellence because I associated myself with a DSO or whatever the case might be, and they feel like, oh, you got to be able to do this crown in 40 minutes, 50 minutes, and this is how much time you have. Like, I'm assuming that that's not necessarily the case with every DSO, that once you partner up with them, they start dictating like, oh, you got to do this many scaling root plantings, or you got to do this many crowns, or you got to do this many night guards and all that kind of stuff. I mean, there's, you do what's best for your patient, but then there are numbers that have to make sense. So are there DSOs that, yes, they're going to have production goals, but they're not going to come down on you? Well, they might, I guess, come down on you and say, well, you're not doing many crowns. What's going on? Like, you gotta do something different.
I think you've got to bifurcate the DSO marketplace into two different types of DSOs. There are DSOs that kind of have that clinic mentality. Those are typically large, de novo focused DSOs that employ young grads. They don't buy practices. They start their own practices, and they kind of have that doc in the box mentality. And yes, you're going to deal with a lot of that crap from a clinical perspective. The DSOs, most of them that acquire practices, they think the opposite of that. They buy quality assets with good clinical leadership and try not to screw them up, right? And if they get in your way clinically or try to institute quotas or what have you, you're going to be unhappy. The practice is going to suffer as a result. So they buy good practices from good clinicians, let you do your thing chairside, and then they try to support you from a business administrative perspective. That is why the DSOs have become a legitimate, more accepted option than they were 10 or 15 years ago. Because 10, 15 years ago, all that existed was that clinic-based doc in a box type model. This is DSO 2.0. It's a completely different animal than that other side of the marketplace.
Mm-hmm. Yeah, I mean, there's so much to unpack here, because there's obviously nothing wrong with private practice whatsoever. I think at the end of the day, you have to decide what's right for you. There are doctors that are severely burnt out. They're just done with it. I mean, the mental stress is so tough on them that they don't want to practice anymore. And for some of them, that's that outlet that they look for, is what can I do to alleviate some of that stress? And there are people, their practices, they thrive. I mean, they love that day-to-day challenge. They love those problems that come up, and they can solve those problems on the daily. So in my opinion, there's nothing wrong with either one of those options. You just have to do what's right for you. I think I'm becoming more and more open-minded with some of that after talking to some people, and after experiencing some of the stuff with staffing issues and all that kind of stuff. Some of those things come to your mind. What can I do? But at the end of the day, I know what I want. I know I love the challenge of practice ownership. So I personally don't have any reason at this time to sell. But at the end of the day, you have to keep your mind open. You have to basically make sure that you know your why. And that's what you keep focusing on, is your why. Once you figure out what that is, you stick to it, you make it better, you continue to work on it. And if you are realizing that why is kind of moving, it's a target that's moving away from you, then maybe you explore different options at that point.
Yeah, I think it's smart to be aware of what your options are, to be educated. Doesn't mean you need to go down that road, but you need to be aware of it and open to it. And I can speak from personal experience, right? So we built our company doing doctor-to-doctor transactions. My company's been around 37 years, right? Up until 7 years ago, we had never sold a practice to a DSO. And we fought it as hard as we possibly could. We don't want DSOs to come into our marketplace and buy practices. We don't think it's good for dentistry. We don't think it's good for doctors. We don't think it's good for patients. And there came a time when it was like, oh, okay, hold on. This new iteration of DSOs is different. I can tell that because I've heard some good stories. And we're actually doing our clients a disservice by not getting educated and getting involved in this side of the space. Because if we don't, there's going to be nobody there to protect them when private equity pushes into the space as hard as they have. So for a long time, we were like anti DSO. And slowly we came around, and I'm still not I'm not an advocate. I'm not somebody that's out here saying everyone needs to sell their practice to a DSO.
Right.
But it has become a legitimate option. And if, emotionally, economically, your why, it's all in alignment and it makes sense, go for it. But if it doesn't, just keep doing what you're doing. That's always an option. You don't have to do anything.
Makes sense. Hey, I'm going to apologize to some of you guys in advance. I saw there were a lot of questions coming up. I don't think I asked all of them, but I know we're about an hour 20 into this, so I don't want you guys to get bored here. Brandon, will you take a look at that video? That's going to be posted in DIG, and just feel free to answer some of those questions. And if anyone needs to get hold of you, I know you're in the group, but is there a number they can reach you at?
Yeah, absolutely. Like a crazy person, I'll give you my cell phone. It's 512-660-8505. My email's Brannon@dentaltransitions.com. That's our website, dentaltransitions.com. Check it out. It's got a DSO resources section. It's got a lot of podcasts like this, some articles on it. I'm here to be a resource for your audience. So people are free to reach out, anytime. If they're thinking about going down this road, if they want to get educated about the option, maybe they've got an offer in front of them and they want us to weigh in on it, I'm happy to take a call.
Sounds good. Thanks, man. I appreciate it. And thanks for being a good friend. I know that I've had a lot of doubts. I mean, and I still do, don't get me wrong, but I think you've opened my eyes to really to look at things in a different way, to look at things from a different perspective. And I think it makes sense, because at least you're able to look at things that don't make sense, and then you look at them from a different perspective, and then, okay, maybe there is something to it. So I appreciate that.
I appreciate that. Always good catching up with you, Sonny.
Yeah. All right. Well, thanks so much, guys. Hopefully you guys finish the week strong. The market kind of stuck today, so hopefully, I don't know, maybe just this bear market volatility that we're dealing with right now. But yeah, there was actually a lot of discussion about buying all these bonds and T-bills and all that stuff. So it's interesting how our conversations have shifted, from these high growth, risky stocks to buying bonds. Who knew?
I bought a bunch of T-bills today. So yeah,
so,
never thought I would own T-bills.
Yeah, that's just the way it goes. So, all right. Thank you guys. Take
Have a good
care.
night.
Have
Bye-bye.
a good night.